Alright, how we doing, y'all? I know how everybody is. Um, you know, we all like to catch those runners or chase them. And chasing, it's not a good thing. But I've found something that we can do that, will allow us to chase them a little bit as long as you're not risking a lot of your account. I would say no more than 1% of your account if you're going to be chasing runners or pennies or something like that, just because they are risky. Sometimes they can jump around on you. So just keep that in mind. Um, but as far as what we're looking at here, it's going to involve three different exponential moving averages. One's going to be the 17, the 6, and the 2. And I also like using with this strategy the Heikenashis for this strategy anyway, because it helps to eliminate some of the noise. And of course probably the 5-minute time frame or larger. As far as with this particular strategy. But the only times that we'd be looking at going long is when price and our moving averages are above the 17-day moving average, and the only time we'd be looking at going short on them is when the price and the moving averages, the 2 and the 6, are below the 17. So just keep that in mind as one of the rules. And then what we'd be looking at here is where we're looking at going long, right? This took off. We're not going to be trying to catch this initial move. We're just not. Not in this particular instance for this strategy, okay? And we wouldn't be worrying about, trying to catch, the initial move. But as far as what we'd be looking for, let me see if I have to show you right here. This may be a little loser right here, but we'll get it right back. But basically, let me go ahead and grab a line here as well and put it on here so we have it available. Okay, so we're looking at going short when we have both of our moving averages below our 17-day EMA, and we'd be looking at, well, they're not both below right here, so we wouldn't be going into it, and it didn't necessarily do what it needed to be right here. So we'll look at this long setup. Okay, so we're looking at a 6-period moving average and a 2-period moving average being above our 17. And we have our 2-period moving average. It comes back down towards our 6-period moving average, where our, basically our sellers are stepping in, or less buying, is happening. And then our trigger candle to get in would be when our exponential moving average of 2 steps back away from our 6-day moving average, okay? And that would be our trigger candle telling us that, it's dipped back down towards our 6-period moving average, and then we have our buyers stepping back in this candle, causing the moving averages to separate, okay? And we're above that 17, so we know we can go long. So we would enter on this candle right here. Stop loss could be either just below, or it could be below the lowest swing low, the nearest swing low. Okay, and after each candle forms, you could take your stop loss and move it up under each one as they formed. Okay, once they are completed. All right, and then of course you'd be kicked out by, actually this wick right here would kick you out, because you'd have your stop loss right here for this candle, and this wick right here would kick you out. Okay, and if you missed that, you could potentially get in right here, because your moving average came back down towards, and then it started pulling back away. When your buyers got back in, you could enter, same deal. Okay, and that's basically the strategy, and you would just look for that setup alone. If you were, catching a runner that someone had, talked about or called out that you saw was running or whatever. But make sure there's news and actually something that's causing it to run, because we don't want to just be jumping in there just because it's going nuts for no reason. Okay, alright, now, if we continue on and we just look at, I just pulled a random, it was on top gainers. We have right here, there's no sell setup whatsoever, just because the 2-period crossed over, will cross back above the 6-period moving average, and we don't want to go for the crosses, okay? So we'd be looking at another long setup right here, where both of our moving averages are above, and it pulls back down towards, and then we have our buyers stepping back in this candle, and the moving averages are stepping back apart. Okay, so if we pull our up here so we can look at it. Okay, so our entry candle, well, let's see, would be right here. So our buyers step back in, stop loss underneath it. It forms, next one forms, next one forms, and so on and so forth. And you'd probably make a little small profit because you'd have gotten in at the bottom of this candle, and you'd probably be kicked out by this one right here. Okay, or if you wanted to, like I had mentioned over on this one right here, if your stop loss was here, you could move it up incrementally. As you're getting into profits. You know, when this came back down and touched back down and then started taking back off, I probably would have moved the stop loss to here, so then you could catch that move. And then as soon as price broke back down through both of these, that could have been your exit point. So that is two different ways of, you know, entering, well, exiting or whatnot with your stop loss. So if we just continued on and we just see what we've got going on, we're not seeing any signals of what we need for it. So we just be patient. We just be waiting and waiting and waiting. Okay. And then we see right here that this is kind of real close. Excuse me, my phone's going off. It's real close because it looks like it did actually cross, so we may not have taken that one. We may have. Either way, it'd been profitable, but even if we didn't take this one, right, we're looking at it comes back down towards our 6-period moving average, our 2-period moving average coming back down towards our 6, and it's above our 17, so we'd be looking at going long again. So this would be our entry candle where the moving averages step back apart. Our buyers are stepping back in. Entry candle, and then we would enter right here. Well, this would be our trigger candle. My bad. And then of course we would take this moving average and follow it up underneath each one of these, and then you'd probably get kicked out by this one. And all in all, even if we took a little small loss, we were profitable because we caught the bigger moves. Like this one right here may have been a small loss. Let's just say that was a small loss. You caught this big move and this big move, and you're good. You're profitable. Okay. You could even venture to guess. You see this little point right here. That could have been potentially that this would be our seller stepping back in, and that could be our trigger candle to go short, because we do see that the moving average did make a small move back towards this exponential moving average of 6. So that's something to just watch for, because it doesn't have to be a big movement, just like we're seeing right here. It came back down towards right here, and buyer step back in, and we got a bigger candle, and the moving average step back away. Same thing happened here. Okay, and it's just something that you can use, to add to your tool belt. Of course, we'll have other strategies, going forward. We'll talk about, supply and resistance and all that kind of stuff as well. I know that's kind of a daunting thing for a lot of people, but we'll get more into that, with multiple time frame analysis and everything too, into the strategies that we get into the future. This is just something that you can add to the repertoire of, tools that you have, and hopefully it will help you along your way. But anyway, it's been good. Stay tuned for the next one. Have a good day.